Good day everyone, I am Christine Joy Daran Legaspi and my partner is Roslyn June Leal and we are from BSBA 2A. Today we are going to discuss about trade finance. So first, what is trade finance? Trade finance represents the financial instruments and products that are used by companies to facilitate international trade and commerce. Trade finance makes it possible and easier for importers and exporters to transact business through trade. It is an umbrella term, meaning it covers many financial products that banks and companies utilize to make trade transactions feasible. How trade finance works. The function of trade finance is to introduce a third party to transactions to remove the payment risk and the supply risk. Trade finance provides the exporter with receivables or payment according to the agreement, while the importer might be extended credit to fulfill the trade order. The parties involved in trade finance are numerous and can include banks, trade finance companies, importers and exporters, insurers, export credit agencies, and service providers. And now, let's move on to the methods of payment in trade finance. The methods of payment in trade finance includes cash in advance, letters of credit, documentary collections, open account, and consignment. Let us discuss first cash in advance. With cash in advance payment terms, an exporter can avoid credit risk because payment is received before the ownership of the goods is transferred. For international sales, wire transfers and credit cards are the most commonly used cash in advance options available to exporters. However, requiring payment in advance is the least attractive option for the buyer because it creates unfavorable cash flow. Second, letters of credit. Letters of credit or LCs are one of the most secure instruments available to international traders. An LC is a commitment by a bank on behalf of the buyer that payment will be made to the exporter, provided that the terms and conditions stated in the LC have been met, as verified through the presentation of all required documents. The buyer establishes credit and pays his or her bank to render this service. An LC is useful when reliable credit information about a foreign buyer is difficult to obtain, but the exporter is satisfied with the creditworthiness of the buyer's foreign bank. An LC also protects the buyer since no payment obligation arises until the goods have been shipped as promised. Third, documentary collections. A documentary collection or DC is a transaction whereby the exporter entrusts the collection of the payment for a sale to its bank or remitting bank, which sends the documents that its buyer needs to the importer's bank or collecting bank, with instructions to release the documents to the buyer for payment. Funds are received from the importer and remitted to the exporter through the banks involved in the collection in exchange for those documents. Documentary collections involve using a draft that requires the importer in exchange for those documents. This is involved using a draft that requires the importer to pay the face amount either at sight or document against payment or on a specified date or document against acceptance. The collection letter gives instructions that specify the documents required for the transfer of title to the goods, although banks do act as facilitators for their clients. Documentary collections offers no verification process and limited recourse in the event of non-payment. Documentary collections are generally less expensive than letter of credits. Fourth, open account. An open account transaction is a sale where the goods are shipped and delivered before payment is due, which in international sales is typically in 30, 60, or 90 days. Obviously, this is one of the most advantageous options to the importer in terms of cash flow and cost. but it is consequently one of the highest risk options for an exporter. Because of intense competition in export markets, foreign buyers often press exporters for open account terms since the extension of credit by the seller to the buyer is more common abroad. Lastly, consignment. Consignment in international trade is a variation of open account in which payment is sent to the exporter only after the goods have been sold by the foreign distributor to the end customer. An international consignment transaction is based on a contractual arrangement in which the foreign distributor receives, manages, and sells the goods for the exporter who retains title to the goods until they are sold. Clearly, exporting on consignment is very risky as the exporter is not guaranteed any payment and its goods are in a foreign country in the hands of an independent distributor or agent. Consignment helps exporters become more competitive on the basis of better availability and faster delivery of goods. Selling on consignment can also help exporters reduce the direct cost of storing and managing inventory. Here is the payment risk diagram of the exporter and importer from least secure to most secure.
Now, let's proceed to export loan guarantees and insurance. But first, let's discuss what is an Export Credit Agency or ECA. An export credit agency offers trade finance and other services to facilitate domestic companies' international exports. Most countries have ECAs that provide loans, guarantees, and insurance to help eliminate the uncertainty of exporting to other countries. Understanding export credit agencies. Export credit agencies originally came to fruition through the government trying to support local companies and increase their product or service export business. The respective services were offered to minimize the risk of participating in international markets and decrease the barriers to entry for domestic businesses. Also, it is a private, governmental or quasi-governmental agency which provides support to promote the export of goods and services from the country in which the export credit agency is based. The support can take the form of loans, guarantees, or insurance depending on the mandate the ECA has been given by its government. Loans. The ECA provides a loan to the overseas purchaser of an export to enable the purchaser to finance the purchase. Guarantees. The ECA provides a guarantee to the lenders financing the purchase of an export, guaranteeing repayment of their loan in certain circumstances. This guarantee lowers the risk of transaction and allows lenders to enter into financing which might otherwise not be possible due to credit or jurisdictional issues. Alternatively, the ECA may guarantee a loan made to an exporter in order to facilitate exports. Insurance. The ECA provides insurance and sometimes reinsurance to exporters against non-payment by the overseas purchasers of their products. An ECA may also provide political risk insurance to companies based in its jurisdiction investing overseas. Next, types of risks. The insurance usually covers commercial risks such as buyer insolvency, bankruptcy, or default. It is usually covers some political risks as well, including war, terrorism, riots, revolution, currency inconvertibility, expropriation, and changes in import or export regulations.